going to crack into it today because we have a bit of a double header, which is obviously very fortunate. We have Paul Ashworth, first and foremost, coming from us live at the desk from Cameron Harrison. Thanks for making the trip along. Always great to be face to face. We had almost. It's a shame that we didn't have like a little spy mic or something like that in the studio, because we're having a couple of conversations about where we think inflation and earnings are going. We saw a big move in bond yields overnight. There was a bit of chatter from the Fed, up 20 basis points. Everyone had been calling the peak in the cycle of yields. You have a different opinion. Why?
The key reason, Carl, is the Fed has to meaningfully reduce growth and has to reduce wages growth. I know it's perverse because through COVID, they're exactly the things that they wanted to increase, in particular wages. So for that to occur and for wages growth to get to a position where inflation is within their range, we think it's unavoidable that there has to be a 4% plus cash rate or Fed funds rate in the US.
Does something break? That sounds really, really high.
Well, I suppose differently from other cycles, where inflation has been. Inflation is the primary issue here, and there is going to be secondary collateral damage. As I said, it's going to be economic growth. It's going to be wages, and we're at a different point, obviously, in terms of employment, both here and in the US. So they're going to be the collateral damages.
Okay, so if we get to a federal funds rate, right? We're talking 4% for federal funds rate. That being the case, does that mean inflation, you think, headline inflation in the States is going to continue to move higher, or is it going to be more the case that it's going to be stubbornly hard to bring down? Or maybe a bit of both.
Yeah, look, I think the issue in terms of where the Fed finds itself is just in terms of where inflationary expectations have got, where wages growth had already got to. And we've got to bear in mind that wages in the US had a reasonable clip on them in terms of growth rates pre-COVID. So the conditions were somewhat stronger in the US than what they were here. Now we do see that inflation should moderate. We just happen to think that the Federal Reserve, also likely the case here in Australia with the Reserve Bank, they are going to do whatever it takes. And we saw that overnight with Governor Daley's commentary out of the Federal Reserve. They are going to do whatever it takes. And there's going to be the collateral damage, as I said, of economic growth and wages. And also, the bit that we think equity markets are missing, there's going to be significant collateral damage for earnings.
Yeah, okay, so that's almost, and I'm going to coin a phrase here, sort of like an inverse Draghi, and whatever it takes, but in the other direction, to obviously crush the economy. So I would assume just the subtext there is that US economy goes into recession at some point, next year? But the markets are pricing in rate cuts. So do you still obviously see that if growth does go negative?
Well, we've seen where markets were a few days ago and where markets were overnight.
Yeah.
They're turning on a dime.
Yeah.
So I think markets they're balanced as to those two schools. I think the position that we put in that rates have to go higher, we're probably in the minority view there. I would say that for recession to occur in the US, it's going to have to happen in the goods sector. Mm-hmm. It's going to have to happen in construction, the residential housing sector, autos. We can see there's continued strength in services, and services is the greater part of the economy. So to your point earlier in terms of inflation, that's where the inflation steam's going to be in terms of that services sector.
I want to get onto the equity market implications because, again, that's going to be a really interesting conversation to have. But one more, just I guess, on the macro rates kind of dynamic. the labour market in the United States, we start to see the jobless rate in that scenario pick up as well, perhaps above 4% higher. Because I do note, as well as an aside, the latest economic projections from the Fed did suggest, an unemployment rate that will climb to around 4.1%. Yep. Higher than that? What are we thinking?
Well, are we better than central banks at predicting? Yeah, for us, it's about the balance of risks.
Right.
The balance of risks are clearly unfavourable in terms of employment. The employment numbers go hand in glove with wages growth, and in terms of capacity. From those levels, we think the balance of risk is worse rather than better.
Okay. And again, another comment we were making just off air, the way that equity markets are interpreting this, perhaps a great example of eternal optimism in this. What's the thesis? What's going on?
Sure. We think, and it really goes back to what we were talking about before. If you are of the view that the Federal Reserve is going to have to hit a 4% handle in terms of achieving its inflation targeting objectives, we would say that equity markets have discounted that, as had bond markets, but equity markets over the last few weeks had aggressively discounted that. And I think they'd so aggressively discounted that they were prepared to chop out a whole piece of the economic cycle, and that is the potential risk for recession in those sectors of residential, housing, construction, and autos. And I think there's a real significant risk to that. And we're starting to see that. It's only at this point in time a bit of a blip in terms of the S&P 500 earnings revisions, and I think the equity markets will be forced to bring that into its assessments, where I think to date they've conveniently wanted to overlook it and jump that whole part of the cycle.
Yeah, okay, so potentially some, fatal conceit there from equity markets and investors. A theme that we'll have to pick up another day, because we've got to wrap it up there, but really, really novel ideas. We love it when it's a bit out of consensus, I suppose you could say. Paul Ashworth from Cameron Harrison, thanks for your time.
Thanks, Carl.